Okay, so hello everyone. My name is Vikas Agrawal, and I am the founder of AIF and PMS Experts India. Well, AIF is your alternate investment funds, and PMS is nothing but portfolio management services. And we are emerging as one of the largest platform for investing in alternative investment funds and portfolio management services. To know more about it, you can also visit our site at aifpms.com and get the required details. At AIF and PMS Experts India, we keep organizing these knowledge-based sessions, and the whole idea of organizing this session is to invite the industry experts, the fund managers, try and read their mind, learn from their valuable wisdom, and decode what is happening in equity markets. And we also try and understand that what kind of strategies that they are running in, which can help our investors to create additional alpha. So the today's topic is, all of us know that we're going through a sort of turbulence time, I would say, in the markets, that the last 3, 4 days were like bad and then suddenly market bouncing back. Now, this is the time when we need to understand that how do we sort of make volatility as a friend instead of considering them as enemy, and see to it that how do we create this momentum and generate additional alpha. So with me, I have two seasoned gentlemen joining the call today. So first of all, thank you so much, Deepak, for accepting our request and taking the time out from your busy schedule and making it. Uh, and also with me, I have Mr. Anoop. Anoop is a fund manager at Capital Mind. Capital Mind has been into this PMS business for quite some time now, and they manage about 2,000, more than 2,000 crores, with help of about 1,150 investors, who have been onboarded. So the journey started well. They are based out of Bangalore. They are one of the best and deserving manager, I would say, both in terms of the quality as well as the understanding of the markets. And particularly when we want to talk about this strategy, momentum strategy, we'll understand more in detail that how did they manage to develop this mechanism, I would say a quantitative methodology in which they not only track the market, but try and generate additional alpha, no matter what the direction of the market may be. So that's the whole idea. So I'll just quickly introduce Deepak for the benefit of everyone, and then probably I'll hand it over to him without any further ado. So he's the fund manager, entrepreneur, techie blogger. In fact, they started their journey as blogger. I'm glad to share that their understanding of the market helped them to become one of the most deserving portfolio managers in India. So excellent work done there. Author, also forever student of financial markets, and I personally have been following Deepak for over 5 years now, 7 years to be very precise, and he one a couple of his tweets are very very informative. He started as an algorithm trading firm way back in 2009. He also co-founded a couple of startups like Agni Software and Money Yoga. Before starting Capital Mind in 2010, Capital Mind is, as I said, is Bangalore-based services that they started, and they are into wealth and investments basically. So the Deepak's passion for finance and investment has led him to become a frequent and respected presence on television, where his views are well invited by various anchors in various TV channels and well perceived by the investor community as well. And of course, his expertise. So he's also an author of an insightful book called Money Wise, which provides reader with an essence guidance on managing personal finance. That's very, very important aspect. So without any further ado, I would hand it over to Deepak ji. Deepak ji, thank you so much for accepting our request, and now over to you.
Thank you so much, Vikas. I don't know if I can hear me. Yeah, I think you can. Should be able to. So Anoop and I will take you through the presentation. We'll share us. I'll share my screen. Anoop, I'll do the first few, and then I'll transition over to Anoop. Let me just. Oh, it's needs
not allowing you to share.
Needs permission to share this.
Whom should I allow, Anoop or Deepak?
You can allow me.
Okay.
Yeah.
Sure. So you are the host now.
All right.
Okay,
Yes.
Anoop, do you want to take it? I can come back.
I'll share my screen. Maybe you can just talk through the first couple of slides and then
Yeah, and maybe
hand it
Deepak,
over.
if you can also talk to us about your organization
Yeah,
and
yeah.
your
We'll
fund
start with that.
management thing, and then we'll hand it over to Anoop, and then we'll have Q&A. So the total
Perfect.
duration is about 40 minutes. Over to you.
Perfect. Perfect. Okay, awesome. So, firstly, thanks so much, Vikas. And it's been it's been an interesting journey at Capital Mind. We started, of course, earlier, but the PMS started in 2017. We established as a company in 2014, though the idea has been around for a long time. Capital Mind has been a blog earlier, before that, since 2005. So there are lots of people who read our articles. We have reached more than 500,000 investors through capitalmind.in. In fact, we have our podcast, which has more than 50,000, actually it's now 500,000 plus downloads. And also, as a PMS itself, we are managing assets of about 2,000, nearly 2,200 crores, 2,100 plus crores, with 1,100 clients across individuals, HUFs, corporates, family offices, and the like, all over India, and very few, but some people abroad as well. Um, we've had a fairly good run on the markets, about 30% plus 5 year CAGR. All Anoop's handling of the momentum strategy over 5 years plus has returned magnificent, nearly 2x the Nifty in that time frame. And also, most of I mean, a good portion of the AUM that we have is actually customer returns rather than just their investments. Frequently, we get covered on CNBC, on ET Now, on Mint, and a bunch of other channels as well. But primarily, our focus is on two things: keep it simple, keep it straightforward, be as data oriented as we can. Quantitative strategies, we are the first to launch in India. Anoop will take you through the momentum strategy. Uh, uh, um, we are also just as a quick introduction. I mean, we are about 30 people now. In an office, we have a building in HSR layout, 4 floors, 12,000 square feet. Please do feel free to hop in if you're in the vicinity. We have a Starbucks on the ground floor, and most of the rest of the building is where we are. So uh, I think Anupavi, I think the next slide would be moment. Oh, yeah, here we go. This is me on the left side. Anup is on the right side. He's the fitter of the two. I'm trying to get there, but it's going to take some time. I'm also a board member of the APME, which is the Association of Portfolio Managers in India. I've written a book. I am at Deepak on Twitter, and I have degrees in computer engineering and an MBA from NMIMS. Anoop is, of course, he manages momentum. He manages another portfolio called Resilient as well. He's also authored a research paper on momentum investing in India, because momentum investing is a globally understood phenomenon. He's looked at that and talked about how it applies to India as well. And he has been with A.T. Kearney, Microsoft, and of course, Didi from ISP as well. And he's at Calm Investor on Twitter. Awesome.
All right.
Hand it over to Anoop. Thanks.
So in the interest of time, I'm going to jump right in. Today we've essentially going to be talking about two of our active portfolios. One is Adaptive Momentum and the other is Surge India. So I'll talk a little bit about Adaptive Momentum, give listeners a decent sense of how that portfolio is constructed, what is the investment philosophy, and what is it that you need to watch out for when investing in a strategy of this nature. And then sort of Deepak will talk about Surge India and how that's been doing over the last few years and what the underlying investment philosophy is. So just to start off with the Adaptive Momentum portfolio, we started the PMS portfolio back in 2019. It's been over close to about 5.5 years. So in that time, 100 rupees invested in that portfolio would be worth about 367. Compared to that, something invested in the Nifty would be about 236. The Nifty 500 would be 264. The only reason I'm mentioning this is because our objective of any active strategy is obviously to be able to beat the benchmark by a reasonable margin for it to be worth the time. And the return that you see here is net of our fees, STT, as well as transaction costs. So that's all that is kind of accounted for in the number that you see here, just to set the context. Moving on, looking at overall portfolio performance metrics over that period of time, the CAGR that sort of translates to about 27% over that 5.5 year period, with volatility that's been slightly below that of even the Nifty and the Nifty 500, with significantly better drawdown. So drawdown is basically how far does the portfolio fall from its peak, given any correction that happens in the market. And this is an important part of how we've kind of constructed the adaptive momentum portfolio, and I'll talk a little bit about that as well. So before getting into momentum investing per se, I would like to sort of create a distinction between what I would call traditional investing and quantitative investing. So I think traditional investing we're all fairly well aware of, in the sense we look at a company, we value it, we try and say what that company should be worth given its growth prospects, and then if that number is below what the market is currently valuing it at, then you call that company undervalued, and then you go and buy that company and then hold it, waiting for that company to reach that optimal value so that you can get your return. So quantitative works a little bit differently. So I do want to set the context by kind of clearly differentiating between the two. On screen is what I would call a typical valuation framework. This is our version of putting down all the different variables that go into valuing any given company. Now, don't worry about all the details on this page. I'll just talk about it mainly comes down to there are external factors like what's currently happening in the markets, which kind of includes things like what is the overall macro environment like, what are the interest rates like, what do regulations, especially with respect to publicly traded companies, what are they like at any given moment in time. Then there's competition. There is the competitive setting that any company kind of operates in, which includes how easy or difficult is it to enter that particular space. What is the buyer power in that space? What is the supplier power in that space? Are there multiple suppliers, or does the industry rely on just the one or two big suppliers? Are there substitutes for the company's products or services easily available? And what is the overall impact of technology obsolescence on that space? So all of that is the external context in which a company operates. And then there's the internal context, which is basically the management, the quality of that management, how good are they at setting the strategy, executing on it, what is their track record been? And then every company obviously owns certain assets. This is both the tangible and the physical assets, like their plants and the machinery, and as well as the intangible, their brands, their IP. So for example, for a Google, their IP would be their search algorithm. For Coke, it would be their brand. So all of that sort of feed into how much return that company can generate on the assets that they own, which is what flows through into their financial performance. So and all of that is kind of driven by something that fundamental analysts call the moat. The moat is nothing but what is it that the company has, which its competition either does not have and cannot get. So that basically tells you how long a company will be able to make its superior return going into the future. So basis all of this, you have to estimate what the future cash flows are going to look like, discount them all back to get a present value, and say that value is essentially what you're comparing the market valuation with. If that present value is less than the market's value, then that stock is undervalued, and you buy it and you hold it till that discrepancy corrects. So this is basically how a typical fundamental analyst would kind of look at any company and then flow through that process of analyzing all these different aspects before arriving at an opinion whether that company is undervalued, overvalued, is it fairly valued, etc., and then take a call. So now kind of moving into setting, how is it distinct from what a quantitative investor looks at the world like? And the best analogy I could think of was the difference between cooking and baking. So those of you who cook know that a chef can kind of uses a lot of intuition and experience to create a dish. A chef can make the same dish slightly differently each time. They can put a little bit of one spice put a little bit less of one ingredient and still make a pretty good tasting dish. It involves a lot of subjective as well as objective decision making. Baking, on the other hand, and those who've done it would know, is very precise. If you're baking a cake and the recipe says that the oven has to be 240 degrees before you start the process, it needs to be 240 degrees. You can't, if you leave it at 220, the cake is not going to work out well. So baking is a lot about following a very precise recipe of tested steps, which kind of brings me to, linking it back to investing in general. What a traditional approach would be a combination of using a bunch of qualitative and quantitative inputs, which is everything from their balance sheets to their cash flow to the quality of management. How good are they at managing a business? The process itself has a lot of subjectivity to it, like I already mentioned, right? On that valuation framework page, there were 5 or 7 inputs. Each of them can be interpreted differently by different analysts to arrive at what that fair value for that company will be. The pros of the traditional approach are obviously well understood. They are like, it involves really deeply understanding any individual business. You can't do that kind of evaluation without knowing everything there is to know about that company, which means that somebody who's really good at doing this will be able to identify undervalued opportunities which others might miss at that point in time. The cons are that whole effort that's a lot of effort for any given company. So it's fairly time consuming to do. Also, there might be biases involved. So certain investors might say, well, I don't like the power sector, I don't like the airline sector, which means even if there is value there, they might miss it because they're just not willing to look at those companies in depth based on their past experience. And lastly, risk in traditional investing is completely subjective and up to the manager's discretion. They might choose to decide that, well, these companies are overvalued, I'm going to exit them, versus I'm going to keep holding them and see what happens. Quantitative, on the other hand, relies on a much narrower range of inputs, but much more comprehensive set of data. So if I'm only looking at, let's say, 10 inputs, for a quantitative process, I need historical data for those 10 inputs going back 15 or 20 years to be able to make a good process, which means it's a narrower number of inputs, but much more comprehensive in the data that I need. The process itself, like baking, is very objective. You backtest a whole bunch of potential ways of picking the portfolio, and then you stick to that process going forward. You obviously refine it over time, but it's important that you follow those rules that you've set out for yourself. The pros are that it reduces emotional bias. You're not subject to feeling euphoric or depressed based on what's happening on any given day. You are following the process. So, and because it's a process that picks a whole bunch of stocks at the same time, there is diversification automatically built in. The cons are, of course, it's a broad-based approach, so it can overlook the nuances of certain companies. There might be certain companies that look either very expensive or poor quality, but might actually be great value picks depending on what happened to them in the last 12 months and what's likely to happen. Risk in quantitative strategies tends to be managed systematically, and I'll talk a little bit more about that. So these are just the 2 broad schools of thought in terms of how to manage portfolios. And adaptive momentum, the way I'm speaking about it, is purely a quantitative process, and that distinction is kind of important to sort of lay out before we get into it. So how do we come up with investment strategies based on quantitative approaches? So there's 2 schools of thought. One is that any good decision needs good data. So we've got 2 quotes here. One was by a legendary statistician, Edward Deming, who said, "In God we trust, the rest must bring data." So for you to believe in any quantitative process, you need to see the data validate that whole thought process. Without that, it doesn't matter. On the other hand, the downside is, if given enough time to manipulate or work with any data, you can pretty much prove anything. You can prove the one point and prove the opposite of that using that same data. So it's important to keep a balance between these 2 points of view when you're looking at an overall investment process using quantitative approaches. So just as an example here, we backtested this a while ago. Just as an example, what if we were to buy stocks which are all making 52-week lows? We went back up until 2007 from over 2 decades of data. We said, what if we were to do it consistently? Buy stocks which are making 52-week lows and held them, and compare that to what you would get if you were to just buy and hold the Nifty. And you can see here that kind of a strategy would have done disastrously, even though intuitively it might feel like, well, buying stocks which are significantly below their all-time highs or 52-week highs would be fairly useful because you'd be buying those stocks cheap. Turns out the data actually tells you, no, you'd be much better off just holding the Nifty. What if you were to do the complete opposite of that? So if you were to buy stocks at 52-week highs instead, and you were to do that every month over 16, 17-year time frame, it would have done better than the 52-week low strategy, but it would still have underperformed the Nifty. So this is the whole process of coming up with a quantitative strategy where you start with a what if, and then you kind of use data to either validate and prove or disprove that investment approach. That's essentially what quantitative investing is. Without having done it, going back 15, 17 years, ideally even longer, but the Indian markets, given we are at a very nascent stage, we don't have that kind of luxury. In developed markets, you've got data going back not just 30, 40 years, but even a century to validate such investment approaches. So at Capital Mind, we think of a three-step process overall to arrive at any kind of a quantitative investment approach, which is basically validate, build, and then deploy, which is starting from an investment thesis, which is nothing but a what if, and then actually collecting the data, making sure that the data is correct, backtesting it, looking at it from various angles before finally deciding whether it makes sense as an actual portfolio or not. And each new strategy goes through this process. Each existing strategy goes through that process of monitoring and adjusting and refining as we learn more and more with time. So now let me come to the principles of momentum investing, and it's kind of there's a lot of I would say misunderstanding about how momentum investing works. I've heard a few different versions of it from different people. So for one is, while it might be reasonably new in India, it has been talked about over probably in the last couple of years. It's a very well researched concept or investment philosophy worldwide. One of the first most important papers came out in March of 1993 by two professors who were working at UCLA, who examined this whole idea of what if we bought stocks that have been doing well in the recent past and then we held them for a certain amount of time. So that basically came out with the conclusion that this seems to work. They did this on the US markets, obviously. Since then, there's been a lot more research on this entire topic, examining how does momentum work in its various shapes and forms. So there's been papers that have been published over the last 15 years, looking at various different markets, looking at different flavors of momentum. And typically, most of them have found that momentum seems to work overall, not just in individual assets. So it works in equities, but it also works in other asset classes. And it also works across developed as well as developing markets. That last one, the one on the top left, is a particularly interesting one because the authors of that paper are Eugene Fama and Kenneth French, who are actually Nobel Prize winners for their work on what is called the efficient market hypothesis. That is a theory that every finance student learns in business school as part of their core finance courses, which basically said that all information is already baked into the price of a stock, and therefore it's impossible to make excess return using any specific active stock picking strategy. But having published that and having won the Nobel Prize, they actually came back and published this other paper years later saying that momentum was one of the anomalies which they could not be explained by the efficient market hypothesis, that momentum seems to persist and give excess return in spite of everyone seeming to know about it and its principles being well understood. So this was the global setup of how momentum works. So we sort of started examining momentum in India back in 2017, did our research. We published our own paper saying, checking whether momentum works in Indian markets, and sure enough, it does. That is where we were fairly confident in the ability of a momentum type strategy to actually work at scale in Indian markets. So I'll now quickly talk through the, leaving aside all the jargon, etc. I'm going to talk through what is momentum investing in 4 easy pictures. So what is momentum investing is, it's basically picking stocks that have done relatively better than the rest of the market. So if you assume that there are only 2 stocks in the market that you're investing in, stock 1 being the blue line on this chart and stock 2 being the red line, then you would pick stock 1 as of T0 when you're building the portfolio, given that it has done better than stock 2. So that is one very easily understandable core concept of momentum investing. The second is a momentum strategy enters after it has been proven, after momentum has been proven, and it exits when it's gone. It's as simple as that. So if the blue line here has been going up for a while, and then at T0 is when you're building your portfolio, because it has been going up relative to the rest of the market, you buy that stock, you hold it till the point that momentum shows, continues to prove itself. Once it's gone, you exit. As simple as that. The third is probably a little more nuanced in terms of how you're building your momentum portfolio. Given two stocks, both have done extremely well in terms of their historical return. So both have gone from the bottom left corner to the top right in terms of their price. But the blue line has gone up relatively consistently, while the red line has been bouncing all over the place before it got to the same place. In this case, you would pick the stock, the blue line. So essentially, a momentum portfolio needs to be adjusted for volatility. Given the same returns, you're penalizing the stock that is more volatile, and you're giving a benefit to the stock that is less volatile when you're picking your portfolio. That is a key factor in controlling or managing risk in a momentum portfolio. The fourth point being, it is a portfolio approach. So it is high conviction on the process and it's low conviction on individual stocks. So at any given point in time, it will buy a set of stocks. In this example, on this chart, I've said 4 stocks, A, B, C, and D. Out of those, 2 which do well continue to be held, and the 2 that don't will be exit at some point in the near future, and then that money will be deployed into the next set of stocks. So you should almost think of this as a portfolio approach where you expect that half of them are not going to give you positive returns. So just summarizing the process on this chart, it starts with looking at the entire universe of stocks, scoring them on our definition of momentum and price volatility metrics, eliminating certain stocks based on certain conditions that we have put in. For example, stocks that see very volatile volumes tend to be slightly manipulated stocks, could be stocks that are seeing some shady investor practices. Those that tend to get eliminated. We also eliminate stocks that are moving up in circuits. Typically, again, those can be problem stocks. And there are a few other filters built in. After elimination, we then pick the top 20, 25 stocks in order to build our portfolio. And that same process gets repeated at each rebalance. And that's how the portfolio kind of runs on a consistent basis. Now, a few lessons just to give a real world perspective on what it is to be invested in a momentum like strategy. We've done this for over 5 years now with a reasonable amount of capital. So we'd like to talk through, I'll just talk through those. So one is a momentum approach assumes that we know less. The 4 charts on the screen are actual portfolio constituents at different points in time that either were there and then are no longer there, or are currently in the portfolio. What you will see in each of them is before a momentum portfolio buys them, the stock needs to have been going up for quite a while. Now that's very hard for certain people to kind of be okay with, saying that you're not buying the stock at its low. You're actually waiting for the momentum to prove itself before you decide to buy it, because the assumption here is that there are other folks in the market who are tracking those companies closer, who know more about those sectors, potentially insiders who know more about the prospects of that company, and therefore we're waiting for that momentum to prove itself before we get in. The second one, this is an important one, is a momentum investing strategy, especially ours, can be wrong a lot. Like I talked about how it is a portfolio approach where nearly 50% of the positions will not give you profits. So this is a stock which this chart basically shows how long different positions have been held, and the y-axis is telling you the returns from those positions. So the concentration of red dots in the bottom left are the positions which were taken, but then which were exit at a loss. The whole point being is to contain the losses and let the winners keep running, which is how you make your excess return in the long run. Another point about momentum is it is agnostic to market cap as well as sectors, which means it can literally go to any part of the market when it is picking stocks. So the 4 panels that you see here, at the top of those, you'll see the industry that those stocks were from. one was a utility project financer, one is aerospace defense, a steel producer, a consumer durable manufacturer. It doesn't matter what sector a stock is. If it is showing momentum, it is a candidate. The other thing to note is you'll see that a lot of those stocks, the examples here, were doing nothing for quite a while. The one on the top left had its IPO in 2007. And then for 12 years, the price didn't go anywhere. It was not mentioned by any analyst. It was not part of any famous portfolios. It was not part of any mutual fund portfolios. Barely any mention of that. But then it's something changed sometime in 2022, 23, which is when the stock started moving up. Even then, nobody was really talking about it at that point. But the momentum portfolio picked it, and based on the rules, it made the cut and became part of the portfolio. Now you'll see a lot of analysts talking about that same stock. There are a lot of analyst reports talking about price targets of 600 and more for that same stock. So the advantage of a purely quantitative approach is that we're not going by sentiment around who's talking about that stock, what kind of coverage, what are the target prices for that stock. If it meets those criteria, then it becomes part of the portfolio. Another thing about the way we run our momentum portfolios, we're very aware of trying to keep drawdowns to a minimum. So the charts that you see here, the one on the left is basically showing you during that period in 2020, when the COVID crash happened, between Jan and March, momentum signals started telling us that momentum was going out of the market as early as February. The number of stocks that were qualifying to be part of the portfolio was coming down quite drastically, which is when our portfolio started increasingly going into cash. So it first sort of went into 10%, then 20%, and by the time at the end of March came around, we were almost entirely in cash by that time. And that you can see in the chart on the right, where the Nifty fell significantly and momentum kind of didn't. And that is part of the risk management that is built into the portfolio, which does not mean that it protects against all declines, but the objective is to try and avoid really bad declines of 30-40% from where it is really hard to recover. Another thing about momentum is it works because it stops working. So this chart here is the 1-year rolling return of the momentum portfolio. The purple line is the momentum portfolio, and the other two are the Nifty and the Nifty 500. And there have been phases when the 1-year rolling return has trailed the Nifty and the Nifty 500. And those periods can last anywhere between 12 and 18 months. So that happened over the last, at some point in the last 5 years. The same thing we've seen in the back tests going back 15 years, that there are periods when the portfolio seems to trail the benchmark. This is when most people tend to lose faith in a momentum kind of an approach and say, well, it stopped working, then no point being invested in it. But this is a key part of what the momentum portfolio will do. If you hold it at different points in time, it is going to trail the benchmark, but we know from the backtest as well as live performance that it comes back and it delivers that excess return over time. This is the probability of underperformance literally quantified, where if you were to invest today, 1 year from now, there's a 35% chance that you'll have underperformed the benchmarks. You saw that on the previous chart. But if your holding period goes up to 3 years and then 5 years, that chance that you're going to be outperforming the benchmark goes up quite significantly, which means your probability of underperformance comes down quite significantly. So one key ingredient in making returns from a quantitative momentum kind of an approach is the willingness to hold for at least 3 to 5 years, if not more, to actually see that return come around. And finally, a lot of people talk about the model and talk about all the rules and how that information gets analyzed. And then, so there's two edges or two ways to have an investment edge. One is you have better information than what the rest of the market has, or you have it before what others get to know about any given company. The other is how you actually analyze that information, the strength of your models, how you look at that same data. And the general understanding tends to be that a combination of informational analytical edges is what is going to give you that superior return. The reality is there's actually three kinds. There's information, there's analytical, yes, but then there's also how you behave in terms of investing. And behavioral is a significant element of what contributes to the edge in momentum investing. So that's something that I mentioned to all prospective investors, is that these three things together, and behavioral is something that's in the investor's control and not so much in the fund managers, which is a key part in the potential return that you could get from a momentum type of an approach. And I'll end with this idea that while it might seem unintuitive to think about a strategy that buys stocks that have gone up a lot, if you really think about it in daily life, we are drawn to momentum all the time. If you go to a new city and you're walking down a street looking for a place to eat, and you see one restaurant that's really full with lots of people standing outside, and you see another restaurant that's completely empty with barely any tables occupied, we are most likely to pick the one that's crowded. That's just human behavior. Another example is if you were looking to buy air conditioners and looking at reviews on various e-commerce sites, we're likely to pick the one that has a high number of decent scoring reviews than the one which has very high ratings but very few reviews. It's just human nature to rely on the opinion of so many other people who bought that same product before deciding to buy it yourself. Another is obviously social media. Everything that we see on our social media feeds is based on what other people are watching. The more a video gets watched, the more it gets pushed to the feed of other people. And finally, if you receive a petition to sign, the chances that we're going to sign go up if it has already been signed by a lot of other people, as opposed to only 4 people had signed it. Then the chance that we're going to sign it is significantly low. So the point is this, that there are these behavioral factors that impact our behaviors, and scientists have kind of done the research and said, well, social proof, the idea of relying on the wisdom of crowds, the availability heuristics, things that come to mind easily, being reliable, and the bandwagon effect. We're comfortable climbing onto a trend when it is widespread and everyone else is doing it. And this just seems to apply a lot to investing as well, which is why a quantitative momentum approach seems to have worked not just in India, but in several other markets across many asset classes. So just coming to a quick summary of how the portfolio itself has done over the 5 years that it's been around. The chart here shows you that it's done fairly well in terms of returns with respect to the benchmarks. And it's been around for a while. It now manages a little over 900 crores in capital. We've seen the strategy evolve. We've worked on it, improved it as we've gone along. It holds roughly 20-25 stocks any given point in time. The universe tends to be the NSE 750. We filter those out for those which don't have enough liquidity, etc. But basically, this is the nuts and bolts of the strategy, and it's done reasonably well over a decent amount of time. So who should ideally think about investing in an adaptive momentum strategy, right? So one is, if you listen to what I've been talking about for the last 10-15 minutes, then you find with a strategy that is based on quantitative metrics and behavioral economics instead of individual company analysis. You're comfortable with frequent buying and selling. The churn on a momentum strategy tends to be significantly higher than most other strategies which are buy and hold. And that is a key part of the design of the strategy. You understand that if there aren't enough momentum signals, and the strategy will go to cash, and it does that periodically, fully or partially. And lastly, if you've had some experience with long-term fund managers with the buy and hold worldview, and would like to kind of try a different and a disciplined approach, then this kind of a strategy might be something that you could consider. So that's what I had in terms of talking about the adaptive momentum portfolio. I'm going to hand it over to Deepak to walk through the fundamental portfolio that is Surge India.
Awesome. Thanks, Anoop. I think that's exciting, because I think also because momentum is different from a lot of other portfolios that you might have seen. But some of what I'm going to talk about right now is probably what you've heard from other fund managers as well. But it's another portfolio we have. The idea of Surge India is that India is surging. This portfolio used to be called long-term multi-cap earlier. It has changed to Surge India because after the Ukraine war, we realized there's something very unique about India-specific, India-facing companies because of a three-pronged approach. The government and the world itself has pushed India to start Indian companies to make in India. make for the Indian population to spend who spend in India. And those people also have excess earnings and they are going to invest in India. These are three themes that we saw emerging very long back. And we said a few things that are happening over here is the government is giving you incentives to manufacture here, to build more here. There is a lot more income happening primarily as a result of a growing economy, but also a result of the manufacturing push as well. But because of the higher income, people are able to have discretionary spending that is higher. Now, I'm not talking about across the population. I'm talking about the population that is relatively higher earning. The discretionary spends means that you're not spending only on the absolute essentials. You're spending on stuff beyond that. So there's more consumption happening. We're moving our savings to financial assets rather than real estate and gold. And I'll come to that. And in general, this is a growing economy compared to the West, which seems to have problems in terms of growth. How do we address this in Surge India? We look at 5 different themes. One of them is called import substitution. The idea being India imports a lot. On your left is a graph with a trade deficit in India. This is trade, okay? Trade is made up by service exports. It's made up by remittances, which is what Indians send from abroad to here. And it is made up by foreign investment into India. But the trade, which is what we buy as goods, is largely deficit. And that deficit is $120 plus billion in USD. We import a lot. We import almost everything, including LED lights. Most LED lights are not manufactured in India. Instead, the government of India said, listen, why are we importing so much? Is there a problem for you making here? They said, well, you know what? Everybody else incentivizes their manufacturing companies. We don't. The government introduced something called a production linked incentive. This is different from a export linked incentive where you're actually saying produce here. Now you sell here or you sell abroad. That is your wish. So what's happening, for instance, is defense localization. Then defense used to almost entirely procure from abroad. Now the defense has said there are certain items we will only procure from India. Vehicles, we're one of the few countries that actually make cars. So we've had a local car manufacturing setup for a long time, but a lot of the ancillaries are also set up here. So the manufacturing over there is improving. Because of the improvement in manufacturing setups, there's also people who might make machinery for manufacturing, and that industry has almost always been either an arm of an a foreign company or a relatively small thing in India. But that's also getting a lot of move. And then semiconductors. We've never had semiconductor manufacturing in India, and now we're getting a lot of push to do that. We buy companies who are in these spaces, and the idea over here is to also make tariffs so that it helps these companies sell in India, because if China wants to dump something in India, we put tariffs on it so that that price is not so low. Going to the next part, another theme here is energy independence. Just like import substitution, we import a lot of energy. But what if we said, listen, let's use different forms of energy? So the idea being reduce crude imports. On your left is a chart which says the net import of crude, which is just crude oil, right? So it's the big part. It's more than $100 billion. But the net merchandise imports is substantially lower than that. But I mean, if you look at it overall, your merchandise import deficit will actually go to zero if we reduced crude imports by half. And how do we do that? Crude is more largely used in transportation, which is diesel and petrol. If instead we move to EV, if instead for energy generation, we move to nuclear and reduce our imports of coal, we go to renewables and so on. So you will actually change the phase of the movement of this country from a crude dependent economy to something that has more widespread and diversified place. A lot of companies here will benefit from the transmission space, power generation space, power financing space, and so on. So today we are going to see a doubling of our power capacity in the next 8 years. And I think in that process, a lot of companies will see a significant increase in turnover. We buy those companies as part of our portfolio. On the next theme, we have infrastructure and logistics. So the idea is India is building a lot of roads, a lot of ports, a lot of rail, expanding the rail network. Look at the rail network on your left, that's the dedicated freight corridor. There is a separate line entirely being built or has been built already for goods trains. So goods trains will no longer carry just bogies. They will have containers taken out from ships, put onto trucks, which are then transported onto trains directly, double stacked, sent with new tunnels being created across the dedicated freight corridor. Well, from the east, it starts from near Bombay and goes all the way to the north towards Ludhiana as well, and then Ludhiana to I think West Bengal is another one. This is basically not only improving the freight traffic because you can have more goods trains on a separate line, but because goods trains don't hog the passenger trains, now you can have more passenger trains. So people logistics and goods logistics both improves dramatically in this country. But you're going to not just have this, you're going to have metro rail, monorail, domestic manufacturing of these components for all of these equipments, and the infrastructure providers who make these pieces of infrastructure are all, I think, going to benefit magnificently in the next few years. We buy some of these companies and they're part of this portfolio. The thing that we've talked about is people are spending more, but it's not just people are spending more, they're paying more for the same things. They're premiumizing. They're buying more expensive clothes, more expensive shoes, foods, coffee, sports, everything. So there's an increase in a lot of things, including domestic brands, tourism, hospitality. Are Indian brands, which have never really, we don't have an Indian dosa brand, we don't have an India-wide biryani brand, but they're coming. You've heard of names that you start seeing in some places. You're seeing third wave coffee in multiple places across the country. So these are brands that are emerging and they will grow. I think a lot of such brands will eventually come and become public as well. Some of them have. And I think they will grow substantially going forward. On your left is a chart showing just airplane passenger volumes, and they're starting to pick up quite a bit. But the airlines themselves have become more profitable, at least the ones that survived. And that, I think, is also an indication of how much India is willing to travel. Today, almost every airport is like a bus stand in terms of number of people that are thronging there. If you moved on to the last beat, and this is financialization, if you look at people having excess income over expenditure, that has also been increasing. The people who earn more than 10 lakh per year, there's a CAGR of over 18% over there in terms of just number of people. That is only till 2022, and it's increased further after that. We've seen India's GDP, about 15% of GDP now mutual funds, 64 lakh crores, now about 18%. But in the US and all, it's like 100% plus. In many developed countries, 80% plus. In India, it's very, very low. It's still underpenetrated. Insurance is underpenetrated. UPI has changed the game. It's UPI is now, I think, 25 times the volume of credit cards. There's digitization of investments, digitization of the framework around investments, from mutual funds to stocks to insurance to so on. And of course, our Indian bonds are also going global. People outside India want to buy Indian bonds in rupees, and equities are already quite famous. This is such, and on the next slide, we'll show you a chart of how, if you looked at how returns have been, the green line is the Nifty returns after inflation. So you remove the effect of inflation. Nifty has given you 8.6% after inflation on a 10-year rolling basis. That means the green is just a 10-year rolling chart. So it's almost, for the most part, been above, zero. That means you've gotten much more than inflation. Gold is the gold colored line on this, and it's relatively smaller. It's fallen quite a bit because in the last month you saw that reduction in duty. And a PPF, which is, it gives you some 7%, has given you about 2.5% more than inflation. Inflation is about 5%. So this thing is more. So substantially speaking, we are seeing equity markets doing much better, and people are thronging to it. There's more money coming to equity markets today than ever before. So we buy the players that benefit from this, whether it's the brokers, the exchanges, the RTAs of mutual funds, the depositories, and so on. That is the fund. It has about 30 plus stocks. We rebalance it 3 or 4 times a year. You can see on the left is returns have been not as great as momentum in the 5-year time frame, but reasonably okay in other time frames. Fixed fee only, as you can see, you can look at, we don't charge a profit share. And we use pretty much, we're a market cap agnostic fund here as well. So we'll have representation from small cap, large cap, and mid cap. Currently about 50% large cap, but that mix may change over a period of time. Cool. This is the I think the comparison of both. Very different philosophies. Quantitative evolve algo-based strategies is where adaptive momentum is, where we've seen it over 5 years and 5 months do really well over time. Also protect extreme downsides as well. Surge India is more fundamental bottom up, not as much protective of a drawdown, but has also seen significantly good returns over the last 5 or 6 years. Again, one is a fundamental strategy, one is a quantitative based strategy. Sometimes both will make you returns in the short term. One may perform while another may not, but in the long term, both have done well for us in the past. So hopefully, we would, I can't promise you anything about the future, of course, but I can just tell you that this is what we've done so far. Great. Thank you so much, and I'll reach out to Vikas to conclude. Thank you so much, and please do reach out to AIF and PMS experts if you're interested.
Thank you, Deepak, and thank you, Anoop. Great presentation, a lot of insights, especially the momentum one that Anoop initially began with, given different perspective altogether to our investors in terms of how the behavior should be, and how the methodical approach would help you to deal with these sort of situation. On the other side, Surge India, I'm happy to see the way it has been repositioned, and you're sort of you kind of repositioned it in a manner where there are a lot of things which are aligned with the government of India, their agenda, and that is what they've been developing, and the portfolio is also accordingly positioned. And both the portfolios I saw have been very, very consistent and outperformed the benchmark significantly in the last 5 years. My couple of questions quickly, we can just cross this presentation and come on normal screen, and then I'll start asking. My first question is to Anoop, is that what is the churning that you have witnessed so far, the average churning ratio in the last 5 years in momentum strategy?
So it's on an average, it churns about 2.5 times in any given year. So if you think of the starting portfolio, that will change about 2.5 to 3 times over the course of the year.
The question next to Deepak is, Deepak, how would this affect with the new change in the tax regime, the short term? The other day I was reading on some lines from you that it will not have too much of impact on the portfolio. So over to you. You are on the way.
Sorry, yeah. The difference in taxation regimes of both earlier to now, we always had to beat, of course, a mutual fund or a passive fund by a certain percentage in order to make for the tax returns. If you assume all our returns are short-term capital gains, in momentum also there are only 90% are short-term, maybe 10% are long-term capital gains. But assuming all our returns are short-term capital gains, if the Nifty does 20%, we should do 23.3% in order to beat the tax advantage. Also the fact that taxes are going out every month has a compounding disadvantage, and dividends are taxed at a higher rate. But 23.3% negates all of this. We have done 31% in momentum. So in that sense, we have more than beaten on a 5-year basis the difference. So on a 1-year basis, the differential is very small. But I'm talking about a 5-year basis. You're talking 23 versus 20. And we've done that in the past. Now, we can't guarantee we'll do that, but that's our aim. We have to beat it by this considerable advantage. And tomorrow, taxes will change. And therefore, you may find a different answer to this question. What if short-term and long-term are both made the same? If then then we'll have a different argument, or at that point. But I can give you the answer for what the taxes are today.
Yeah, the other thing is I would tell my investor is that, you have to have exposure to, long-term investments and portfolios like Surge, where you have to have good amount of exposure. But you also have to have exposure in momentum strategy also. It is very important because it deserves allocation in the overall scheme of things. So one should not look at only from a tax point of view, but also to be looked at from a strategic allocation point of view, is what my thought process is. The other thing is, Deepak, is that this portfolio, the surge one that you are running now. So how many companies that you have in the portfolio, and when you get the money, when you're getting money now, what's your deployment strategy? Are you deploying or staggering the investment?
So we typically deploy everything in a month. Today is not a time when I would even advise doing a staggered like 6-month kind of deployment. But typically within a month, we deploy the whole thing. We have about 31 companies, different weights. So we will start buying on day one and slowly build up the portfolio over time. This is expect though that we will deploy almost all the money into the portfolio itself, because I know that people are very worried and all that stuff, but I am not worried. Because I'm not worried also because people are too worried. Also I think the markets are not so expensive today that I should tell you that we should be at fundamentally speaking, we should not have investments in the market. So I think I will deploy them fairly quickly now. And if there's a significant fall, we'll definitely deploy more of it.
And yeah, during that time, we as an advisor come into play, as in we reach out to our investor and tell them to do more of top-ups, because that's a time that we should average out.
Last Monday, we got a significant amount of top-ups. So
yeah. And thankfully now these, especially AIF and PMS investors, are aware investors, so they understand that, when you've taken the call, you should be listening to your fund managers and their thought process, and should be looking at it. Anyways, my question to Anoop is, Anoop, what would be the percentage, if you have to quantify in terms of numbers, the large cap, mid cap, and small cap in your momentum strategy at this point of time, as well as historical number, if you can just throw some lights?
So because that actually keeps changing depending on when you were to ask this question. So as of today, it's about 50% large cap, 30% mid cap, and 20% small cap. But if you had looked at the portfolio 6 months ago, it would have been a lot more small caps in that mix. It would have been close to 50% was small caps, and then smaller percentage in the other. So it really depends on what the market is doing at any given point in time, which is where I call it a truly flexi cap strategy, in the sense it can go almost entirely large caps. It can go a significant part into mid and small caps. And the whole idea is to manage risk while trying to optimize for return.
Same question for Sarge also. Deepak, over to you.
Sorry, what was the question again? I couldn't.
The bifurcation between large cap, mid cap.
Right now, it's 50% large cap, and about the rest are mid and small cap mix. But again, these change. Some stocks which we bought, which were small caps, have become mid caps. Some mid caps have become large caps. So that also changes. So that way, today, luckily, we are at our largest positions are LIC, Reliance, and L&T. So that continues to be, and all of them we've made significant profits from the time we got in. So I think those are this thing. But we have a lot of other stocks as well. Started off small. In fact, a few railway stocks that have done 6x, 8x, 9x. So they've become mid caps, become large caps, in fact. When we started off as small caps, so that way I think we're not keen on having a certain mix. I will buy the stocks, and if they're large caps, so be it.
Yeah. Are you concerned about the valuation in the small cap? Because historical piece suggests that you are at about 2022, but currently it is going beyond 30s. So are you concerned about that, Deepak? Does this give you some sort of worry?
Well, you'll always be worried about valuation, even if it's too low. I don't think that's this thing. But people have talked about valuation since last December. Market is up 40%. Our portfolio is up 40% since then. If we had gotten out purely because of valuation, we would have not made this 40%. So therefore, I don't think valuation is a metric that you should get out of stocks on. You should get out of stocks from fundamental reasons, but not really just on valuation.
Yeah. Do you also see that the other school of thought, in the market, is that there are a traditional way of investing in the markets, like your Asian Paints of the world, which were the darlings of the markets and have been muted. Their earnings continues to grow, but the appreciation and the stocks have been sort of muted for quite some time. Do you see some mean to reversion A out there, and do you also see some mean to revision in from value to growth?
Value to growth, in fact, both value and growth are doing well. Those companies are quality companies. That's why they're not doing well, because they have been valued at a very high valuation earlier. So HDFC Bank was 40 times earnings. Now it's 16 or 17 times earnings. Asian Paints was 90 times earnings. Now it's 60 times earnings. So the earnings multiple comes down. Your earnings goes up. The stock remains at the same price. So I think that valuation change gap has come in. Whether there's a mean reversion or not, I don't know. But I know this, the market gives every stock a chance. So hopefully every stock, even in the quality universe, will have a chance at some point. But it looks like this is the time for value and momentum, and also for growth. Growth is, I will search the growth portfolio for the most part. So a tremendous amount of move in growth as well.
Yeah. So
Because,
yeah.
I'm sorry,
Yeah.
I have to run. I have another meeting happening.
Sure.
Is that
So
okay?
we'll conclude that. I think we had a very good discussion. So thank you so much for your time. With that, we'd like to conclude the session here. It was wonderful interacting with you, Deepak and Anoop. Thank you so much, for taking.
Thanks a lot, Vikas.
Thanks a lot. Cheers. Thank you.
I will just. I think Anoop, you make me host. Yeah.